Welcome to Talk Tickers.
Great to be here.
Usually when people talk about the stock market, they're obsessing over the chart. Is the line going up? Is it going down? It's all very two-dimensional.
Very 2D, yeah.
But today, we're going to break out of that 2D world. We're going way, way deeper. We're cracking open the engine room of the options market to see how the whole machine actually works.
And it is a complex engine, to say the least. I mean, honestly, for a lot of retail traders, it just feels like a black box. You press a button, and you buy a call, and you kind of hope for the best. But for the institutions, the market makers, the hedge funds, it is definitely not a black box. It's a dashboard.
A dashboard, right? And that dashboard is exactly what we're decoding today.
Yeah.
We aren't just looking at, gambling on direction.
No.
We're looking at options trading as engineering. It's about managing these very specific mathematical dimensions of risk. And we have a lot to get through. Everything from the basic physics of price to some really heavy technical stuff.
Yeah, machine learning and Gaussian process surrogates.
It sounds terrifying, I know.
It sounds like something from a sci-fi movie.
Right. But it's actually changing how money is made right now. Our mission today is to sort of bridge that gap. We want to move from, I hope this stock goes up, to, I understand the mathematical forces acting on my portfolio.
That distinction is everything. It's the whole ball game. Gambling is hoping the dice roll your way. Engineering is, it's measuring the weight of the dice, the friction of the table, the air resistance, and then placing a trade where the probability is mathematically in your favor.
And the tools for that measurement are the famous Greeks. Delta, gamma, theta. But we aren't just going to read dictionary definitions today. We're going to look at how they interact, how they fight each other.
Yes.
And how modern tech is trying to rewrite the rules on how we even calculate them.
That's the trajectory. We'll start with the physics of price, delta, and gamma. Then we'll look at the time and volatility. And then finally, we're going to get into that cutting edge stuff about how algorithms are learning to price options better than the standard models we've used for 50 years.
I love it when we get to challenge the standard models. So let's start with the basics, but let's do it right. The Greeks. To me, they always sound like fraternities, but in the market, they are your sensors. And the first one, the big one, is delta.
Delta is the heavyweight. It's the first thing any professional trader looks at. But I think it's also the most misunderstood. Most people learn delta as a probability percentage. A 0.30 delta means there's a roughly 30% chance.
Right. This option finishes in the money, which is a useful rule of thumb, sure, but that's not really what it is.
Exactly. Technically, and more importantly for risk management, delta is a ratio. It measures directional risk. It answers a very simple question. If the underlying stock moves $1, how much does the value of my option change?
Okay, let's unpack this with a concrete example.
Yeah.
Let's say I buy a call option on some tech stock. It's trading at $100, and the option has a delta of 0.50.
Okay, so if that tech stock goes up by $1
to $101.
You're $101, right. Your option price should theoretically increase by 50 cents.
Simple enough. It's like a velocity.
That's a great analogy. Delta is velocity. It tells you how fast your position is moving relative to the stock. But there is another way to look at it that the pros use, which I think is even more powerful.
Share equivalency.
Share equivalency. This is the part that really clicks for people.
Yeah.
If you have that same option with a 0.50 delta, it acts mathematically like you own 50 shares of the stock.
Which is why you hear people talk about getting long 50 deltas.
Yeah.
They aren't buying stock. They might not own a single share of the company.
Not a single share. But their portfolio behaves exactly as if they do.
And that's where the leverage comes from.
Precisely. To buy 50 shares of a $100 stock, you need $5,000. To buy one option with a 50 delta, you might only need, say, $500. You control the same exposure for a fraction of the capital.
But, and here is the catch, and this is where it gets interesting, that speedometer, it doesn't stay still. The delta isn't a constant number etched in stone. It changes.
And that brings us to the second Greek, which I feel is, this is the one that really burns new traders. Gamma.
Gamma. The Greek, that explains why things go crazy.
If delta is velocity, gamma is acceleration.
I remember this from high school physics. Velocity is how fast you're going. Acceleration is how fast you're speeding up.
Right. Gamma measures how fast your delta changes when the stock price moves. Let's go back to your example. You have that 0.50 delta option. The stock moves up $1, you make your 50 cents.
Right.
But now, because of gamma, your delta has shifted. Maybe it's become 0.60.
So the next dollar the stock moves up, I don't make 50 cents. I make 60 cents.
Exactly. You are accelerating into the profit. That is positive gamma. It's curvature. Your profits accelerate as you're right. And crucially, think about the downside.
Okay.
If the stock drops back down, your delta shrinks. Maybe it goes from 0.50 to 0.40, so you lose less on the way down than you made on the way up.
That sounds fantastic. It sounds like a magic money machine. Why wouldn't I just load up on positive gamma all day long?
Because nothing in the market is free. Gamma implies explosive potential. The market knows this. So options with high gamma, usually those at-the-money options right near the current stock price.
And near expiration.
Especially those near expirations, they're expensive. You have to pay for that convexity.
And when you say pay for it, you don't just mean the cash up front. You mean you pay for it with the other Greeks, specifically the rent.
Exactly. Let's talk about the rent. Theta.
Theta is time decay. This is the one that feels personal. It's the ice cube melting in your hand.
It is. Theta measures how much value an option loses for every single day that passes, assuming the stock price doesn't move at all. You are paying for the privilege of holding that potential exposure.
And just like gamma, it's not linear, right? The ice cube doesn't melt at a steady speed.
No, it accelerates. We call it the theta curve. In the last 30 to 45 days before expiration, that decay falls off a cliff. It accelerates dramatically. So if you're buying those high gamma explosive lottery tickets we just talked about,
You're getting burned.
you are usually suffering from massive theta burn. You're fighting the clock.
That is the trade-off.
It's always a trade-off. Time and uncertainty. As time decreases, uncertainty decreases, so the extrinsic value or the premium of the option just erodes.
If I'm a buyer, theta is my enemy. But if I'm a seller,
If you're a seller, theta is your best friend. This is why market makers and income traders love to sell options. They want to collect that daily rent. They're the landlords.
right?
So they hope the explosion, the gamma move never happens, and they just keep the rent check every single day.
Now, speaking of uncertainty, we have to talk about the environment the trade is happening in. We've talked about price and time, but we have to talk about mood, the market's mood,
Vega.
which, as I learned, isn't actually a Greek letter.
No, it's not. Traders just made it up because they needed a V word for volatility.
I love that. We need a variable, let's just invent a letter. So what is Vega telling us?
Vega measures sensitivity to implied volatility, or 5. If a V goes up by 1%, how much does the option price change?
And phi is basically the market's fear gauge, right?
Fear or expectation of movement. Think about an earnings call. Before the call, nobody knows if the stock will jump 10% or drop 10%. Uncertainty is high.
So phi is high.
Implied volatility is very high, and that pumps up the price of the option.
So a high Vega means the option is very sensitive to that mood swing.
Correct. And this creates a classic trap for beginners. I see this all the time. A trader buys a call option right before earnings. They think the company is going to crush it. The company announces great news. The stock goes up $5. The trader wakes up expecting a massive profit.
And nothing.
And the option is actually worth less than they paid for it.
The Ivy crush.
Exactly. The event is over. The uncertainty collapses instantly. Volatility drops. So even though the stock went up, Delta tried to help you. The drop in volatility meant Vega hurt you, and Vega hit harder.
It's like buying hurricane insurance while the hurricane is literally hitting your house. It's going to be incredibly expensive. The moment the storm passes, the price of that insurance plummets, even if your house is still standing.
That's a perfect analogy. You always have to ask yourself, am I buying volatility when it's high? Because if you are, you need a massive move to overcome the crush that's coming.
Okay, so we have speed, delta, acceleration, gamma, time decay, theta, and fear, Vega. There's one more on the dashboard. The forgotten child, rho.
Rho, the interest rate Greek. For about a decade, nobody cared about rho because interest rates were basically zero. It was a rounding error.
Right. But now, with rates hovering around 4, 5, or 6% in recent history, rho matters again. It measures sensitivity to the risk-free interest rate.
And this is where we get into the plumbing of finance. Why does an interest rate change the price of an option? It comes down to something called the cost of carry.
Okay, break that down for us.
Think about it this way. If you want to control $100,000 of Apple stock, you could buy the stock. But you have to put up $100,000 cash.
All of it.
All of it. If that cash could be earning 5% in a risk-free savings account or a treasury bill, buying the stock has an opportunity cost, you are giving up that interest.
Right. I'm losing that free money I could be making on my cash.
But if you buy a call option, you control the stock for a fraction of the capital, maybe $5,000. You can keep the remaining $95,000 in the bank earning that 5%. So when interest rates rise, call options become more valuable.
Because they're capital efficient.
They are more capital efficient. They let you keep your cash working for you.
So calls generally have positive rho.
Yes. And puts usually have negative rho. In fact, there's a specific scenario mentioned in the research where high interest rates can actually trigger early exercise of put options.
This is the edge case I found fascinating.
If you hold a deep in the money put, you have the right to sell stock and get cash. If rates are high, say 6%, you might want that cash now so you can start earning interest on it immediately. You don't want to wait for expiration.
That is a nuance I think most retail traders miss completely. They think I have the right to sell, but they don't think I should sell now to get the interest.
Exactly. It shows how interconnected these variables are. You can't just look at the stock price. You have to look at the whole ecosystem, time, fear, and the cost of money itself.
Okay, so we have the dashboard. Delta, gamma, theta, vega, rho. Now let's talk about how the big players use this dashboard. Because they aren't just watching the dials, they are actively wrestling with them. This is hedging.
Right. Specifically, delta hedging. This is the bread and butter of market makers and institutional desks.
So the goal of delta hedging is delta neutrality, net zero.
You want to be immune to the direction of the stock. Let's say a market maker sells a call option to a customer. That market maker is now short delta.
Meaning if the stock goes up, they lose money.
Exactly. They don't want that risk.
Right.
They aren't in the business of guessing where Apple is going next week. They just want the transaction fee. They want the spread.
Okay.
So to offset that short option, they turn around and buy the underlying stock. If they calculate the delta is 0.50 and they sold 100 contracts, they buy the exact amount of stock to make the net delta zero.
So if the stock goes up, they lose on the option but win on the stock. If it goes down, they win on the option but lose on the stock. Perfectly balanced.
In theory. But remember our friend Gamma.
The acceleration, the fly in the ointment.
The moment the stock price moves, even by a penny, the delta changes. So that perfect hedge you set up 1 minute ago, it's wrong now. It's drifted.
You're chasing a moving target.
Constantly. This creates a need for rebalancing. You have to keep buying or selling stock to stay neutral. And this brings up the limitations we saw in the research, specifically transaction costs.
If you have to trade every time the stock moves a penny, the fees will eat you alive.
Right. And there's a liquidity issue. If you are a massive whale and you need to adjust your hedge, your trade itself might move the market.
That's the feedback loop, right? You buying stock makes the stock go up, which changes your delta, which forces you to buy more stock.
Exactly. It can create these melt up or meltdown scenarios.
Wow.
So how do they fix the fact that delta keeps changing? They hedge the rate of change. They hedge the gamma.
This is gamma hedging. And this is where it gets really complex.
To hedge gamma, you can't just use the stock because stock has zero gamma. Stock is linear. To fight nonlinearity, you need another nonlinear weapon. You have to buy or sell other options.
You're constructing a portfolio of options where the curvature of one cancels out the curvature of the other.
Precisely. It protects you against large, volatile moves. Delta hedging protects you from the first step. Gamma hedging protects you from the sprint.
But this sounds incredibly data intensive. I mean, you have thousands of strikes, different expirations, real-time data feeds.
It is massive. That's why the technology stack is so critical. We read about the need for time series databases that can handle high throughput ingestion. You can't calculate real-time gamma across a whole portfolio using like an Excel spreadsheet.
No way.
If your data is 5 seconds old, your hedge is wrong.
Which brings us to the really futuristic part of this deep dive. We've been talking about these Greeks as if they are these hard and fast laws of physics, but they are based on models. Usually the Black-Scholes model.
Which is a brilliant model, Nobel Prize winning,
right?
But it has flaws. Big ones. It assumes things like constant volatility or constant interest rates. It assumes a perfect world.
And markets are messy. They have what's called volatility smiles.
Right. If you plot the implied volatility against different strike prices, it's not a flat line. It looks like a smile. Black-Scholes doesn't predict that. The market creates it because traders are human. They fear crashes, so they bid up the price of deep out-of-the-money puts.
So if the map doesn't fit the territory, we need a better map. And this is where the research on Gaussian process surrogates comes in. This is where machine learning enters the chat.
This is really exciting stuff. Instead of forcing the market data into a rigid formula like Black-Scholes, researchers are using Gaussian processes, a type of machine learning, to learn the shape of the pricing surface directly from the data.
So it's looking at the messy, noisy reality of trade prices and just drawing a map that fits that rather than a theoretical map.
Exactly. It fits a non-parametric map. It doesn't start with a formula. It starts with the data.
Yeah.
The coolest part about Gaussian processes is that they handle noise and data friction really, really well.
And they provide something called uncertainty quantification. This seemed like a huge deal in the research.
It is a game changer for a trader. A standard formula gives you one number. The delta is 0.52. It sounds authoritative. But a Gaussian process says the delta is likely 0.52, but given the noisy data, there's a confidence interval. It could be between 0.50 and 0.54.
That is huge.
Yeah.
Because if the confidence interval is wide, maybe I shouldn't bet the farm on that specific hedge.
Exactly. It tells you how strict you need to be. It essentially gives the trader a measure of how much do we really know about this price right now. It quantifies the epistemic uncertainty.
It's honest math.
It is. It's admitting that the market is messy.
The research also mentioned the Vanna-Volga method. Sounds like a dance move, but it's actually an FX strategy.
It's very popular in foreign exchange markets. FX is incredibly volatile. Vanna and Volga are what we call second-order Greeks.
We're going deeper down the rabbit hole.
Just briefly, Vanna is the sensitivity of delta to volatility. Volga is the sensitivity of Vega to volatility.
My head is spinning. What is the practical application of that?
Think of it this way. The trader's rule of thumb in FX uses these metrics to adjust the theoretical Black-Scholes price. They essentially add a markup to the price to account for the smile, the fact that the market is weirder than the model.
So they use the standard model as a base, and then use Vanna and Volga to slap on a reality tax.
That's a great way to put it. It's a manual way of doing what the Gaussian processes are trying to do automatically. Both are trying to solve the discrepancy between the clean math and the dirty reality.
So let's zoom out. We've gone from delta and gamma, the basic physics, to the manual labor of hedging, and finally to this AI-driven future where the computer learns the physics on the fly. What does this mean for the listener who is maybe just looking at their portfolio app?
It means you need to respect the complexity. The price you see on your screen isn't just a number, it's the output of a massive dynamic system reacting to time, fear, interest rates, and curvature.
And if you are trading options, you aren't just betting on stock direction, you're managing a multi-dimensional object.
You are. You are managing the curvature, gamma, and the environment, Vega and Rho. If you ignore those, you're flying a plane looking only at the altimeter and ignoring the fuel gauge and the airspeed.
I think the biggest takeaway for me is that the Greeks aren't static. They are alive. They breathe.
They absolutely do.
Here's a thought to leave you with. We talked about how these machine learning models, like Gaussian processes, can learn a pricing surface that is different from Black-Scholes. They learn the market's true shape.
Yes.
So if the machine says the price is X and the Nobel Prize winning math says the price is Y, does that mean the math has been wrong for 50 years? Or is the market simply pricing in risks, human behaviors, fears, black swans that mathematics hasn't even discovered yet?
That is the ultimate question. Is the market irrational, or is it hyper-rational in a way we can't express with a simple equation?
Something to think about the next time you look at an option chain. Thanks for joining us on this deep dive into the engine room of the market.
Always pleasure.
See you on the next deep dive.